some of this is gonna be really useful stuff. Some of it you're going to, you're gonna learn it for the test, and after that, you're not, when you, in real life, you go look this stuff up. If you only use it once or twice a year, you don't really, you just go, I remember from that class, I need to go look this up. If somebody, okay, installment sales, that's not any problem, and there's actually the form on most softwares you can follow, go down the form and do it. Really fairly easy, easier than doing it this way. If you have an installment sale and it gets repossessed, I wouldn't do that without going back and pulling out a book and go look it up. Nobody does. You don't see them once every 5 or 10 years if you see it at all. Okay, so let's get going. We got a couple easy chapters. These aren't so long. Adjustment to basis. Okay. What are basis adjustments? Well, a lot of things. You know, you get your basis get adjusted. You buy a building and you do a bunch of remodeling. You have a rental house and you do remodeling. You have to hire lawyers to, somebody's trying to sue you to take your property away or something. That goes to basis. That's just added. Now, in real life, you don't add it, you don't put it on the building. If you start a building in the year 2016, and in 2019, you're gonna do an improvement to the building, it actually increases the basis of the building, but because the depreciation starts at a different time, you're gonna have two separate lines in your computer in the depreciation. One, let's say, is rental property at 2100 Kalakaua, and the other is gonna be improvements to 2100 Kalakaua, and one of them will start in the year 16, and one of them will start in the year 18, because you'll have to keep it separate because you didn't start it at the same time, okay? Okay, depreciation. Has everybody here done enough tax returns where you generally have an idea about depreciation? Depreciation, we're gonna use makers most of the time. You can also use just straight line depreciation under makers. There's I'm getting ready to talk for an hour in a couple of months about depreciation by itself. There's a lot. They're changing all the rules. Depreciation is, if you don't opt out, is now 100%. So there is no more of the old depreciation like we used to have, where everything was straight line. You have a, let's just say you have a rental property, you bought a furniture or a stove. It's 5-year property. Well, you used to do it, you divide by 5, take a half a year the first year and a half a year, and it would be straight line depreciation. They've done away with that. Now they have what's called bonus depreciation. So you get accelerated depreciation. You might take twice as much in the first year, and then more the next year after that, until it gets to the end. Does that matter for your test? Not so much. Are they gonna ask you, is something 5-year or 7-year? Probably not. You should know, you know, the basics. Computer and electronics are normally 5-year. Rental property things depreciate are 5-year. Business furniture is 7-year. Rental property 27.5. Businesses like and buildings are 39. So you have a great big office building, 39. The things in the office building could be different amounts. So I don't think they're gonna ask you that kind of gotcha questions. You need to know that rental property is 27.5 though. You need to know that non-residential real property is $12.50. Business real estate is usually $12.50. Other assets, they call it $12.45. That would be things you depreciate, like all your furniture, all your refrigerators, most other stuff that's just personal other than real estate. And all of that's 1231. I don't know if they're gonna be picky enough to make you know those rules that way. This book does, but I've never had any other books go so much on calling it 1231, 1250, 1245. Well, so we'll see how okay. One rule that they're always gonna ask is depreciation. It's called allowed or allowable. If whatever depreciation method you use, you gotta take it. You can't opt out and say, I don't wanna have depreciation, it doesn't help me. Or, I've been doing TurboTax and it was too much trouble, so I just didn't take depreciation. And then they come into you after about 5 years later, and you go, and you have to go pull out, there's a special form for people that didn't take depreciation when they were supposed to. They have to recapture the depreciation, or when you sell the asset, you recapture the depreciation whether you took it or not. So let's say you kept something for 5 years and you were supposed to have depreciated it, and it's a $10,000 machine, and you didn't take the depreciation. Well, the rule is allowed or allowable, so now your basis in that property is just like you would have taken all the depreciation. That's not good. So what does that mean? We're not going to get into it. I don't know if they'll even get into it in this class or not. The form is called 3115. There's a way for you to recapture all the depreciation in the year you find out that they did it wrong. So if somebody comes into you, they've been doing this on TurboTax for their rental property for the last 10 years, and this year they're selling and they don't know how to do it. And they come walking in, and you go, well, where's your depreciation? They go, what's depreciation? And you kind of know that, uh-oh. So you have to go fill out a special form. You got to send one copy to Ogden and one copy with the tax return, and it's more humbug. It's probably one of the hardest forms to fill out, but it's doable. And what does it do? You get to recapture the depreciation. So the year that you do it, if, let's just say you should have been taking $10,000 with the depreciation, maybe $1,000 a year, well, you haven't taken it for 10 years, you get the whole $10,000 this year. And it offsets the big gain you would have had. Because, let's say that you have a $10,000 piece of property and you should have depreciated it to zero. Now the property, you have to depreciate it to zero. Okay, so depreciation is allowed or allowable. No matter what, you got to claim it. Okay, then okay, if you have property, and let's just use stock because this is what this normally is. You have return of capital. We're on the bottom of page 238 right now. Return of capital. So the stock is, this will be a question for sure. So you have a stock that costs $1,000 and you have maybe 10 shares, we'll say, it doesn't matter. And they go, so they give you on your 1099 DAV, they give you a return of capital of $260. Okay, so that $260 they gave you isn't taxable, but it lowers your basis in the stock. They're going to give that, sure. So then the next year they do that, and that makes it $740. Next year they take $500. That $500 they give you is not taxable, but it brings your stock down to $240. Okay. If you ever go below the zero, let's say the third year they they give you $400 for the return of capital, but your base is only $240. So now you have $160 worth of capital gains because they gave you more money than your basis, and your basis is now 0. And if they keep giving you any more money, it's all capital gains. That has been a question every year in some form or fashion. Okay? If they give you dividends out of earnings, that's just dividend and it's income. It's not a return of capital. I don't know if they'll do anything about that. Stock rights. Okay. Normally, if you get a stock right, it doesn't have any basis to it because it's nothing until you actually sell it or trade it in for the stock. If you sell it, though, you would end up having profit. Casualty losses basis is reduced by the amount of casualty loss. So let's just see. Well, they're done away with casualty losses except for presidential declared disaster areas, kind of. Mm-hmm. But let's say that I had a machine that cost $10,000. I've depreciated it for $2,000. So it's now has a basis of $8,000. And this year, we had a hurricane, and the hurricane came in and smashed up this machine, and I got it. It's now worth only $2,000. Okay, I got to write off. Let's just say, I wrote off $6,500 of casualty loss on my tax return. Then now I have to subtract that, and my basis would be only $1,500. Or I got to write off $65,000, but they gave me $3,000 in insurance. So then I didn't get a $6,500 loss. I got a $3,500 because I got $3,000 of insurance. So then you take your basis down from the 35. This, they may or may not have anything on there about that. That's not normally, I don't normally see it. Debt discharge. Is everybody familiar if you get a 1099-C? Up and down all day, I guess. So, I get a 1099-C. Here you go. How are you doing? There's, I've got you a bunch of sheets of paper.
Great, thank you.
Did you bring a book?
No, that's safe.
Then you're going to be tough to follow today.
Okay.
But that's okay, you can do. Okay, so right now we're talking about discharge of debt. You get a 1099-C, cancellation of debt. So, cancellation of debt, what happens? Normally, if, let's just say, you had a credit card, and you and the credit card have been arguing, and finally they go, just give us $2,000, and we'll let you out of the $8,000 you owe us. You go, great. You give them the $2,000, and then 6 months later, you get in the mail a cancellation of debt on Schedule C of $6,000, okay? And you're supposed to add that to your income. Actually, it would go on line 21, other income, okay? If it's a credit card, it's pretty much, you can't beat that one very much. If it's a $6,000, the only way, there's a couple things. You could go be bankrupt, or you could be insolvent. We talk about insolvent. I don't know how much they're gonna go into this. What do you mean by insolvent? That means you have the value of everything you have is less than zero. If besides that credit card debt, you had a mortgage of 500 grand that you'd refinanced a couple times, and your house is now only worth 400 grand. So you're in effect underwater up to 100 grand. You see how that works? On the other hand, you didn't, let's just say this way, if you did this, then you wouldn't have to pay on that cancellation of debt, because you're not solvent. You owe more money than you've got. On the other hand, if you didn't have a house and you're just working, you got a job, you're living from paycheck to paycheck, you're just renting, you hadn't got anything, you go, I'm insolvent. But then they go, what about your 401k at work? Huh? What 401? Oh, yeah, I got 10 grand in my 401k at work. Then you're no longer insolvent, so you would have to count that as income. If you had a nice Mercedes worth 20 grand, then you'd have to count that as income, or a nice truck. Will they put that? They will have one question about cancellation of debt. I don't know if they'll do that. They call it, you have to reduce your attributes. If you had this $6,000 and you had a house, even if it was insolvent, you might have to reduce the basis by the $6,000. That's pretty, I don't think they're gonna go anything like that's, but that's called reducing that. Let me see what. I'm not. Thanks, tax service. Yes? Okay. Yes. Real quick, I'm in the middle of teaching a tax class right now. Yes, sir, thank you. No mercy. Holding periods, this is pretty standard stuff. I haven't got a lot to tell you. All you can do is just read this on page 240. There's one thing that for every year they ask. So, they always do this. So, I buy an asset on July 1st, 2016. I sell it on July 1st, 2017. Is that a long-term or a short-term asset? Oh, good God, good. Okay, remember, if you buy it on the same day, it's short-term because it has to be more than a year. Right. And the day you buy it, you're considering buying it on the following day. Okay? Especially like for stock, especially. That used to be a trick question for several years. I don't know if they did it last year, I can't remember. But for several years, that's always been on there. Okay. What are capital assets? Most everything. Here's a list on page 241, but most stuff. What's not a capital asset? Inventory, accounts or notes receivable, copyrights and artistic compositions, when you're the guy that composes them. On the other hand, if I bought the music of somebody else, the guy that wrote the music, that's his, and it would be ordinary income if he sold it. But after he sells it to me, it's a capital asset, and then I would, it would be like, who is that guy? He wrote Thriller, Michael Jackson. All of his works, he would be somebody, whoever owns them, as it's worth a bunch of money, and it would be a capital asset to them. To Michael Jackson, it wouldn't be. Okay, all this example, all these are capital assets, personal home, furnishing, blah, most everything. One thing that's not is goodwill, when generated within the business, is a capital, but if you buy goodwill, it's not, it's amortized. So let's say I sold a business and I sold a bunch of goodwill. The guy that bought the business, he would amortize it, I think over 15 years. They're not gonna ask stuff that picky. But goodwill is amortized. And amortized is almost just like depreciation anyway. Stocks, bonds, commodities, mostly are capital assets except for dealers, people like the company Charles Schwab, somebody like that. They're in the business of selling stocks. That would not be a capital asset, that would be inventory to them. You're not gonna get asked that kind of question, I don't believe. Land investments treated like it's a capital asset. The only thing you can't do with land is what? You can't depreciate land. Okay? It's not in here, but anyway, I'm gonna go over real quick. If you have land, it has a house on it, and you bulldoze the house, you don't get to write that off of bulldozing that house. The cost of bulldozing the house goes in and increases the value of the land. So if your land was worth 100 grand and it cost you 10 grand to clear off the dirt and the rocks, the trees, or the house, or whatever was on it, that just increases your land value. They sometimes have asked that. It's not here, but this particular book I'm just getting used to. The other book I knew where to find stuff all the time. This one I'm having to actually read it to know where it is. Okay. Okay, the sale or transfer of property in exchange for money, what is it called? A sale. Exchanging property for property is called an exchange. So the sale of something for money is a sale. The trading of property for property is an exchange. Does anybody care much? Probably not. But I'm just pointing that out. We're gonna get, in a few minutes, we're gonna get to one of my pet peeves. It's called realized versus recognized. This is, and you really, really gotta get that concept down. What do you?
I have tried so many times to understand that.
We're gonna get, by the end of tonight, you will know.
Okay, good.
I guarantee, because I'm picky about that.
Good.
Okay, and I've even got you a bunch of paperwork. Everybody should have a copy.
Uh-oh. I have.
Okay. Long-term, short-term gains, what do you need to know? Short-term capital gains are taxed how? As ordinary income. Long-term capital gains are taxed how? As capital gains. Okay? So what does that mean? If you have long-term capital gains and long-term capital losses, you combine them, and if you have losses, they're capital losses. If you have short-term capital losses and long-term gains, and you combine them, and they're capital gains, they go to capital gains. If you combine them and there are short-term capital loss, they're ordinary income. I'm not sure where it is in here, but let's just go this one. There's a rule. So, let's say that each of these years you've been having short-term capital losses and you've been writing them off as ordinary income. They used to have this as a test question. So this year, and that one is 0. This year you got a $5,000 capital gain. Okay? So that $5,000 capital gain normally is a capital gain and it's taxed at capital gains rates. But if you've been writing off short-term capital losses as ordinary income, you've got to go back and recapture the 5 years. So, in this case, 6th year, you can't go back and get this one. So that one's gone. I just put it in there to show you that it doesn't count. So for the 5 years, so you go back and you go 3, 1, 1, and one of these would stay as a minus, and this would be captured as ordinary income as opposed to capital gains. Your ordinary income could be taxed at what? 12%, 22%, and then it keeps going up from there. Actually, you could go 10% and 0%, but that's pretty low. Does everybody see how this works? If you have capital gains, and in the previous 5 years you'd had short-term capital losses, and you'd gotten to write them off against your ordinary income, then this capital gains that you get here, you have to go back and recapture. In real life, I don't remember to do that. And how would you do that if you didn't have their 5 years of tax returns? My computer might be able to do it for me if it knew, but I hadn't even been using the software for 5 years. So good luck with that. And I believe that skips through. Now, does it really matter on numbers like that? Not really a lot. But if you were in the hundreds of thousands, it would make a big difference.
How do you go back and recapture? Do you amend your figures?
No. Say, this is the present year, you had $5,000 of capital gains. So, normally that capital gains would be, go to the Schedule D and you'd pay at the capital gains rate, 15% we'll say. Could be 20. It could be 0 if your income was low enough. But if you had, we're just gonna make it easy, 4 years ago, you had $10,000 of capital losses that you wrote off against your ordinary income, then you take this and it reduces this to $5,000, and this is taxed as ordinary income, but in the current year. So you don't go back to any other years and amend them. It just, this would be ordinary income instead of capital gains income, and it would do it on your Schedule D, I believe.
So the negative is carried forward?
This one?
Yes.
For 5 years, yes.
Okay.
Now, if we go for 8 years and have no other capital gains, well, this one's dead. You can't go back more than 5 years, so then it's gone, and you'd start over again. Normally, also, remember capital gains and capital losses first. Long-term capital gains, long-term capital losses, you net them against each other. Short-term capital gains and short-term capital losses, you net them against each other. Then you net the long-term against the short-term. And then you get to one long big number. And if it's capital gain, let's say long-term capital gain, then it goes over to your Schedule D, and you've got long-term capital gains. If you had short-term capital losses, that goes back and that's on ordinary income. And if you might just re-look at page 243, just to be on the safe side, make sure you got it. And 244, I can't really quickly give you an easy way, but remember, if you've got 1250 gains, you're taxed at 25%, and if you have gains on collectibles, you're taxed at 28%. They may ask you something about that, but that's kind of a gotcha question. You don't get much of that in real life. But always remember, especially for collectibles, they're taxed at 28%. Okay, capital gains on sales of stock. Real quick, there's on futures contracts, foreign currency contracts. No matter what the number is, let's just say it's $10,000, they split it between 40-60 between long-term and short-term. So on the little, you got it? All right, no question?
No.
Okay, does everybody understand what I mean? So, you get a dividend statement or something from Charles Schwab, and it has future contracts, and it says 10 grand. Well, hopefully your computer will know to do it for you. I think mine does. But you put this in there, and it's gonna split it up 40-60. 40 short-term, 60 long-term. Does that help you? Yeah, because short-term, long-term.
40 short term and then
60 long-term. It's in the book.
What page? What page was that?
Huh?
26.
246. Okay, thank you.
Okay, section 1202 and 1244 stock. These are stock for small businesses. And what they were made so that people would invest in small businesses. And so they get special privileges. Okay, for your small business, qualified small business stock, if it was after 93 for more than 5 years, if you held it for more than 5 years, you could write off 50%. And then after 2009, you could write off 75%. After September 27th of 2010, you can write off 100%. That's a pretty good deal. And that was trying to get people to invest in small business stock. The qualified small business stock must be that of a domestic C corporation with gross receipts not exceeding 50 million. My definition of a small company isn't 50 million. That's a pretty good sized company.
Yeah.
But you're gonna go through all of this tax code, and they've got small business. And one of them will be maybe 5 or 10 million. One of them will be like this, 50 million. I think there might even be one that's even higher. But it's always just, I get, well, what do they mean? Small business, 50 million. But that's the rule. Okay, the corporation must have at least 80% of the value of its assets used in the active conduct of a business. You can't just go buy stock and sit there with it. You have to be running a business. Okay, and these are the rules for the 1202. Okay? Annual gain for which the taxpayer may qualify under 1202 is limited to the greater of 10 million or 10 times the adjusted tax basis. Those are not small business. 10 million? Okay, sorry to get picky about this. So this is one that's also taxed at the 28%. So 1202 stock, if you gotta pay any tax on it, you're taxed at 28%. That would be the 50 and the 75 exclusions. If it's 100% exclusion, who cares? It's 100% excluded. The 1202, another thing is you can roll it over. If you roll it over within the time period, 60 days, you don't have to pay any tax on it. You just roll it over to the other small business stock. Will they give you this? This might be in the form of a question, which one of these are wrong, and they'll give you 3 parts that are correct, and some little detail in there could be wrong. But they're not gonna make you do a 1202 calculation, most likely. 1244, and you may, similar, an individual may deduct as ordinary loss, a loss from the sale or exchange from worthless small business stock issued by a qualifying small business. Okay? And this one's way different. It says a corporation qualifies as the amount of money or other property if it's got to be less than 1 million. That's a whole lot different than 50 million, don't you think? Mm-hmm. Okay. And this determination is made at the time the stock is issued. You got to be the original buyer of the stock. You can't have bought it from somebody else. So when the company was started, you took a chance on some little company which may go broke, and you bought it, and that's why you're getting these benefits. The maximum deductible as an ordinary loss is $50,000 for a single person, $100,000. So you can get, that's been a question before. How much can you write off as an ordinary loss? Normally, remember, on capital gains losses, you're limited to $3,000. Everybody familiar with that from doing taxes? So $3,000 is your normal limit. So if I bought $10,000 of stock and sold it for $5,000, I'd have a $5,000 loss. This year I could take $3,000 and the other two would carry over. I'd have a loss carryover, and it would carry over to next year, and I'd be able to write it off next year if nothing else happened. This, okay, for all the people that read this chapter, this is, the questions aren't going to be a lot of math questions. Now we get to the next chapter, and it's going to be a lot more work and a lot more fun. Okay, so let's go. Let me just figure out which page to start you guys with. My favorite, the page that says normal transaction at the top, fully taxable gains and loss. This is going to be the meat and potatoes of a lot of questions. So I've got you 2 sheets that are really important. One, it says normal transactions. This is what you're going to use for all your gains and losses. You're going to get a lot of gains and losses on this test. There's also going to be like-kind exchanges that we go in next week. So make sure you bring this page back with you. Then we're going to also go into installment sales. You're going to get at least a couple of questions, if not a bunch, about either installment sales, normal gains, okay? And then partial like-kind exchange and full like-kind exchange. So let's go to normal exchange. The very top, it's a fully taxable gains and losses. What does it mean? I buy a piece of land, then I turn around and sell it. The guy just gives me money. That is really simple. I buy it for $100,000. I don't depreciate it. He gives me $130,000. I've got $30,000 of gain. Okay. So let's go first. Let's look at what we call realized and recognized gain. These 2 words you've got to learn and got to understand them. They even catch me. they're gonna have a trick question on the test where you think they're asking for what's the recognized gain, the part you'd put on a tax return, but they say the word realized. So, we're gonna go through a bunch, but realized is how much you realize. So, and let's just do it from here. On this piece of paper, we go realized, amount realized. Realized means everything you got. In this case, the sales price. It's the cash, the loan relief, the fair market value of assets, less selling expenses and loan assumption. What does that mean? Well, there's a whole, this is what makes all this. So, I have a piece of land that I buy for $100 grand. Okay? Somebody wants to buy my piece of land. They go, look, I'll give you $80,000 cash. I'll give you my old truck, fair market value, $10,000. I'll give you, I've got a $12,000 mortgage on this land. Okay? He says, I'll take over that $12,000 mortgage. That's the same thing as giving me cash. Okay? And he wants to give me, he can give me anything else. I don't want to put land in there because then it becomes a partial like-kind exchange. We'll say that you have $2,000 of selling expenses. So, how much is he giving you? He's giving you $80,000, $10,000 fair market value on the truck, fair market value, and it doesn't matter. He may have only paid $4,000 for that truck. Who cares? It's worth 10 grand. To you, it's worth 10 grand. So he gave you 80,000, 10 grand. He took over your note at the bank of 12 grand. And you got $2,000 worth of expenses. So he gave you 102,000. I made this kind of crummy. Came out exactly even. Then we subtract. What do we subtract? Yep, selling expenses. So, by coincidence, I wasn't trying. So, he gave me 100 grand for my land that I have a basis of 100 grand. So in effect, I would be selling it and breaking even. There'd be no gain or no loss. That didn't happen very often. This is why we're going to have some problems where I've already got everything written out, so when I'm sitting up there just making up numbers, it would come out the way it's supposed to. Well, what is the key? Okay? Let's do one that's a like kind of exchange. We have that same 100 grand, but this one, my basis is 100 grand, but it really has a fair market value of 250,000. Okay? So the guy goes, I'll give you $40,000 in cash, and I'll give you a piece of land worth $200,000, and I'll give you that. We'll just stop right there. So he's gonna give me $240,000 for my land. Even though my land is only, maybe fair market value is 250, he's gonna give me 240. Well, but my basis in that land is only 100 grand. So my basis minus what he gives me is, so I have a gain of 140,000. That's called the realized gain. That's not how much that I pay tax on, that's what I realized. I realized he gave me $240,000. I realized 240. Minus my basis gives me a realized gain of 140. We're not gonna get there till next chapter, but that has nothing to do to the recognized gain. When you have a like-kind exchange, you exchange like-kind property, a piece of land for a piece of land, a rental property for a piece of land. You don't recognize the portion of the gain that has to do. The only thing you're gonna recognize is gonna be maybe the cash and loan if we have one. So my realized gain is 140,000. My recognized in this particular one, my recognized gain would only be a 40,000. So you've got to pay attention when they ask the questions. Are they asking for realized or recognized? Here's one that's going to be in this chapter later on. Okay, so I have Dad. He sells a truck to his son that the dad paid 10 grand for it. His basis is 10 grand. And he sells it to his son for 7 grand. Because they're related with related parties, you can't take a loss. So if I sell to my kids, I can't go taking a loss on that because it's a inside trading kind of deal. So even though there's a $3,000 loss, the dad can't take it. He can't ever take it. But let's say that the son, oh, that was son, whoever. Son later on sells this truck for $11,000 to an unrelated person. Okay? Because he now gets to include this $3,000 that he didn't get, that the dad didn't get to lose. So he's now got $10,000 of basis, and he only has to pay for $1,000 of gain. That saves him a bunch of money. $4,000. Well, this would be $4,000 otherwise. But he does not realize a $1,000 gain. He realizes $4,000. He recognizes only $1,000. The difference in realize and recognize. Realize is what you actually got. Recognize is what you pay tax on. It's what you recognize in the tax code. That's the big deal. So they even tricked me with this question. I just missed it just today. I was going too fast and didn't even look down there. I would just, because I've seen this question every year for 10 years. They always have this one on there. Okay, and so you got to check to see, do they mean realized or recognized? It was a trick question, which I hate, but that's part of being old. So now let's go back to realize and recognize. So all the way through, everything you do, these are going to be really important. Okay, realize. How much do you realize? That's everything you get minus your selling expenses. And by coincidence, it's at the top of this page. Then, that's how much you realize. what is your realized gain? Everything you realize minus the adjusted basis of the asset sold. That gives you the realized gain or loss, okay? Which is separate from the recognized gain or loss. And we're gonna go through a whole couple of chapters before we get all the recognized gains and losses. Then the next part you're always gonna have. That's realized and recognized is all throughout the test. Make sure you read the bottom of the question, read all the way through, then make sure you see the answer and read it. Then reread the question before you answer it. That's just my personal opinion after doing this for a long, long time. Okay, so then you have one thing you have to say, realize and recognize. Which one are they asking for? Are they then the next one is, how do they character the gains and losses? How do they characterize the gain? Normally it's gonna be either ordinary income, and in our book they call it OI all the time. I've never heard that before, but I figured it out after a while. It took me about 15 to 12, what's OI? And then I realized, because I saw it in parentheses next to ordinary income. I've never heard the word before. Okay, so is your income that you're doing, is it gonna be ordinary income? Or is it gonna be long-term capital gains? Okay, real quick, I'll give you a hint. Short-term is ordinary income. If you have it for a year or less, it's ordinary income. You have to pay a higher rate of tax, okay? Depreciation recapture is ordinary income. And those are two of the biggest. So, as we're gonna go through this, you're gonna see, we'll do this one. Okay, so we have $100,000, okay. This is probably gotta go to the trash. $100,000 you paid, and you've gotten $30,000 of depreciation. So your basis now is $70,000. Everybody with me so far? This is going to be the bread and butter of some of the questions. Then they could throw in improvements, raise it up a little bit. They could throw in selling costs, lower it back down. But just, it's all basically going to be this. Then, this is the basis of your property. Then you sell it for some price. And we're going to say, the first time you sell it for $120,000. Okay, minus $70,000 in basis. Oops. So you have $50,000 of gain. On that $50,000 of gain, the first $30,000 you have to recapture the depreciation as ordinary income. So $30,000 of this would be ordinary income, and $20,000 would be capital gain. Everybody got? That's going to be, in some form or fashion, they're going to ask those questions. They're going to go, how much is capital gains? One question, they'll do almost the same thing. And the next one will be, how much is recapture of depreciation? Or how much is ordinary income is another way for them to say it. And how much is capital gains? And they'll have them both on there.
So ordinary income is the 30,000 and capital gains is the 50,000?
Capital gains is 20. So out of this 50,000 of gain, and this is called realized gain. This is your realized gain. We don't know if it's going to be taxable gain or not. The realized gain, the first 30,000 is going to be ordinary income because you're recapturing depreciation. Okay.
And then the 20,000 is the
It's going to be capital gain. Okay. So then we change this around. We now sell this for $90,000. And the basis is 70. So we only have a $20,000 gain. Even though we need to recapture $30,000, we only have a $20,000 gain. You recapture depreciation up to the realized gain. So even though this was 30,000, you only recaptured the first 20. So the whole gain in this case is ordinary income, or the new word OI. These are going to be, this is the bread and butter of a lot. They're going to have a few gotcha questions. You can still pass this and miss all those really goofball questions. Some of the goofball questions aren't even going to count. They have got, part of their system is they ask you questions that don't count just to test all this and see what's going, to see how the system works. So they will ask some really hard questions, and they're not even part of the test, but you won't know that. You'll be going, God, those were so hard. And they're not even counting them.
How many points on the pass?
Huh?
How many points on the pass?
How many points?
Yeah.
105 maybe?
Oh.
But that the questions aren't all valued the same. So some of them are valued more than others. And it might not even be 105 anymore. And that's only on, I think, the first part. I'm not sure if it's all the same. It's either 100 or 120 questions. But you get 3 hours. Go ahead.
Sorry, I'm going back to, so you sell that property for 90,000 and the basis is 70,000. The 20,000
Is realized gain. And what kind, what is the character of the gain? The character is ordinary income, because you have more than $20,000 worth of depreciation that you recapture.
ordinary income, because we can't depreciate the 30,000 or.
Well, okay, if you only have $20,000 of profit, you can't do more than 20,000.
What's ordinary?
Yep.
And where would that go?
So the ordinary, okay, so we had depreciation of 30 grand,
Yeah.
okay? And so we had 90,000 of, that's what they paid for it, and 70 was our basis.
Yeah.
So you got 20,000 of, this is what you realize, this is your basis, and this is the realized gain. The realized gain is either gonna be ordinary income or capital gains. You can't have it more than 20,000 though. No matter what, you can't go over 20 grand. And the rule is, you take the, up to the amount of depreciation, and it's ordinary income. Since depreciation is more than this, the whole thing is ordinary income. Does that make sense, everybody? Now, the good news is they're gonna have problems just like this. The bad news, this is not gonna be the easy, they're hard ones. Okay. So what did we say? Ordinary income is what? Recaptured depreciation and short-term capital gains. So, okay, so what, we could have no depreciation, but if you kept it less than a year, you could have, it'd still be short-term and ordinary income. Does everybody understand that? It's, this stuff is in the chapter, so it's hard. I
But
don't know.
it's easier to understand you than
Huh?
reading it. It's easier to understand you than reading it.
Well, that's a first. All right, just kidding.
So ordinary income is recaptured gain, and what was the other one?
Short-term capital gains is ordinary income, and recapture depreciation.
Depreciation.
And the long-term capital gains would be what? It would be your realized gain minus your ordinary income. Because you subtract the ordinary income and what's left over is your capital gains. All right, now the second part of this, we're not going to go over till next week. But this page, you guys need to get this down so you understand it. So on every one of these, you're going to start off with everything that you get is what you realize in a sale. That's the sales price. Everything you get minus the selling expenses that's what you realize in the sale. Then you subtract from that the adjusted basis, and you get the realized gain or loss. Recognized gain or loss depends on a lot of other things that we'll be going through. You don't always, remember when I was telling you about the son and the dad? So the dad had $10,000, he sold it for $7,000. He realized a $3,000 loss, but he recognized 0. Okay? The son had, he bought it, let's see, he bought it for $7,000. Then he sold it, what was it, for $11,000? So when he sold, he had a realized $4,000 gain, but he only recognized a $1,000 gain. So when you get this question, you got to make sure whether they're saying how much is recognized, how much is realized. Is it how much is ordinary income? How much is capital gains income or loss? And they'll have a lot of times they'll have 4,000 ordinary income, 4,000 ordinary loss, 1,000 capital loss, 1,000 capital gain, and so they kind of look similar. You got to figure out, and what are they asking? Realized or recognized? But it's been this way, and they've been going back to this same well every year. Okay, so let's put this one away for right now. Let's go through the chapter. Oh, it's 7 o'clock. Does anybody need a bathroom break? Any kind of break? I'll take a bathroom break. I don't really need one, but I will before it's over. And it's also give you guys a 5-second. Let me quit talking.
Just one.
$3 on the debt.
Right. And he said 100 question, 120?
try doing this
I'm
in
just kidding.
when you do this online? You do
No.
it online, the problems online?
No. You done it?
Some of it.
Some of it? Yeah. No, not at all.
It takes me more than 3 hours.
Oh, great. Oh,
Just to do
great.
one chapter.
Oh, Lord. Next.
I think it's,
This alone would kill me, I think.
this is so incomplete.
Yeah,
Compared to
to the one you did before.
they have more on the questions online.
Now, yes, you've got a whole lot of more questions that you need, that you can actually go do
Mm-hmm.
if you do all the questions. That's what we were doing last year. Not, well, a couple of guys did. By coincidence, the couple of guys that passed the test were doing all of the questions. Then about 4 other people were not quite keeping up. They didn't do as well. 2 of them, though, they got through 2 out of 3 parts. And I know at least one of them's already, 2 people have already contacted me and saying they want to come back to part 2. That's their last part. They want to finish and get it done. So this is one of the things I suggest. If this is overwhelming you, get through part 1. Okay? Then after you get through part 1, part 3, then if you need to rest up, take a break because it's just too much, then you come back next year and do part 2. It's the part that's usually the hardest, unless you're used to doing corporations, partnerships, and S-corps. But if you have twice as much time, it's easy. And if anybody really cares, you can always, all you gotta do, I'm not that busy right now, I will be glad to help. The only time is on Tuesday. I'm usually catching up, making sure I got everything done. I go back and make sure I've read everything and done all the problems, so that there's always at least a few that catch me. And one of them was...
You do the problems on the book, Hank, or
Yeah.
or online?
I do. For this one, I'm just doing them in the book. On the other one, I did every problem. Just because I could. I haven't even gone and seen the ones online lately. If I would have known the other company was gonna sell out to somebody else, I would have printed all their questions. They had over 2,000. That way, and then I'd have just made copies for you guys. And no matter what, if you go through all the problems, and then instead, okay, here's my also suggestion. When you're going through these problems at the end, don't worry about guessing and getting the right answer. Instead, stop and go back and reread the chapter and make sure you get it. And I will go as far as go get the tax book or the Pump 17 out, just because I care more about getting it right than I do passing some little test on here. And if you do it that way, you have a better chance of remembering this. There's a lot of this stuff that you're gonna learn for the test. That you're not gonna, a lot of it, you're gonna learn for the test, and other than that, you'll go look it up if you really need it. Especially with what we're coming to next on installment sales. You just go to the form and you just type it in. For a simple installment sale, it's easy. But when you have to take back what's the word? You take it back. It's recapture, but it's not a recap. Repossession. You take it, you sell it to somebody, and a few years later they quit paying you. You got to take it back. Or the other one is we're going to go over is you sell something on an installment sale. You get halfway through it, and you're owed about, say, 10 grand, and somebody goes, hey, I'll give you $6,000 right now for that 10 grand. And you go, so get me out of here. And then you'd have a little bit, possibly you'd have a gain. Maybe not. Okay, let me put my glasses back on and we're ready to roll. Any questions about the first part? Had we already gone over stocks? I think we did it last time. But say you bought 100 shares at $5.50. So that was worth $555. They had a stock split of 10% or 10 shares. So now you have 110 shares. What is your price per share? You just divide 110 into 5, or you'd really divide it into here and it would come out to $5. That question has been on there forever. That exact, and it's the exact, they don't even change the numbers. It's this exact same one. But it could be, you know, instead of, there's also some other ones, you know, where stock split, so
What
you
is
get,
it called? Stock split.
okay, a stock split. I own 100 shares in a stock. The company says, we're gonna have a stock split. We're gonna divide our shares in half. Okay? So this is supposed to be $6. I had 100 shares. So now the company says, we're gonna give you an extra 100 shares. So now I have 200 shares. Okay? What is my each share worth? Before, each share was worth $6. Now, if you divide the number of shares into the total cost, it comes out to it's worth $3. And it's still worth the same $600. You get $100 of a stock split, 100 shares. There is no taxable income on that, generally speaking. There's some special rules on there. If you're getting, one guy's getting preferred stock, and the other guy's getting money, and the other guy's getting other kind of stock, that would be different. But normally, you split stock, what? It doesn't change the value of your shares. It's still only worth, the basis in your shares are still $600. All it did was change the price per share. You got it?
So
Any
you got
claim?
100 shares,
They
you
give you
bought, or they
100
gave
more
it to you?
shares.
Okay.
Now you have 200 shares, but they only cost you $600. They didn't. You don't pay tax on it because it didn't change the value of what your shares are worth. You just got twice as many shares. Okay, related party sales. This is what we were talking about before. Remember I showed you the dad and the son? Well, that's for sure gonna be a question. It won't be that exact question. But related parties are not just relatives. But let's just go ahead and go over, what relative is it? It's your parents, grandparents, great-grandparents. Your son, your grandson, your great-grandson. Or your brother and sister. Nobody else. So not your niece, your nephew, your aunt, your uncle. Everybody got that?
Wait, brother and sister should be included or no? I'm so.
They are included.
Oh, okay.
But other than that, it's linear. Your parents, your grandparents, or your son, your grandson, your great-grandson. Other than that, it's only your brother or sister. So if you gave your cousin Louie a special deal, then that's still taxable exchange. Okay, but what happens if they're not? You don't recognize the loss, and if you have a gain, it's ordinary income. Okay, but what I want to also to mention is they're not but if you've got a person and their controlled entity, and it's either 50% or more than 50%, and they're not clear in this book. And that's a picky one that you need to know. So what does that mean? If I own a S corporation, or I own a C corporation or a partnership, and I own more than 50% of the stock in that company, and I sell that company a piece of land, and I would take a big loss on selling that land to that company, I can't take the big loss. I sell the company and I make a gain, a big gain, then I have to count that gain as ordinary income, not capital gain. Even if I've held that land for 5 years, it's still ordinary income.
And it's taxed more.
Ordinary income is taxed higher than capital gains. Yep. Okay, loss realized on sale or exchange of property to a related person is not recognized. So you don't get to take the loss. Okay, and if you have a gain, the gain is ordinary income. So related party, we've already gone through. Controlled entities, they say 50% ownership. I've always thought it was more than 50%, but this book is different than the old one. Okay, so what are we talking about? Anything where you have more than 50%. So what happens if I own 30% and my wife owns 30%? You got to count that together, or my father or my son. We together own more than 50%, and so then the same thing would apply. If you give something like that to an employee, say I have a truck that's worth $25,000, and I've got a good employee, and I go, I'll give you this truck for 15 grand. Well, then in effect, I'm giving him $10,000 worth of salary, of compensation. He's got to count it as compensation. But now his basis in the truck is $25,000. And I should probably count it as compensation too.
So we just add it to his income, it's not in the W-2?
Yes, it would go in the W-2.
Okay.
Yep, everybody good? And I would get to write it off. The business employer would get to write it off. Enter spousal transfers. No gain or loss is recognized on the transfer of property between spouses incidental to a divorce. So if I sell or give my ex-spouse a piece of property and we're trying to disguise a divvying up of the assets as a sale, a gain, or a loss. Let's say I'm in a high tax bracket and she's in a low tax bracket. Or I've got a good lawyer and she has a crummy lawyer. Okay, business property, the section 130, 1231, 1230, just go ahead and read that. That's realized gain on the disposition of 1245 property is ordinary income to the extent of depreciation. We've already said that. A general business credit is considered a deduction allowed for depreciation and subject to recapture. What would that be, a general business credit? Something like solar credits on your business property, not on your personal home, on your business property. I'm not sure that I know anybody that would have caught that, myself included. Now I probably okay? $12.50 is all depreciable real property held for 1 year or more. Okay? Property held for a year or less, any depreciation is recaptured as ordinary income. Land is not section 1250. What are we talking 1250 property? Real estate. Just think something that's got dirt associated with it. It could be land, it could be a building on top of the dirt, it could be rental property on top of the dirt. If you have income that you have multiple assets, you have to apportion them according to what? Fair market value. That's all, that's gonna be there somewhere. And sometimes they have a question like this that says, I was given 100 grand for 5 assets. So we'll say 100 grand for 5 assets. And one asset was 10,000, 20,000, 30,000, 40,000. Okay? That would be exactly 100 grand. That would be really easy. But if one of the assets was 50, now we've got 110,000 into here, and you'd have to do proportional. That would be hard. Let's do it. Let me do it easier. So this equals 200 grand. But they only gave me 100 grand. So proportionally, how would you do this? You would take 100 grand over 200 grand, which anyway, it equals 50%. So you take 50% of this, 50%, 50%, 50%, and that would give you, that's the basis, that's the highest basis you can have. The other way around, if they gave you 400,000 for 200,000, if it's all just perfect like this, there's no problem. But you cannot go above fair market value. So if one of the proportions put it above the fair market value, you couldn't do that. And that's usually a question. But it's gonna be proportional. They won't make their numbers quite as easy as mine. They might make it, 25 or 50, or sometimes they can even make them goofy numbers that you go, oh man, I gotta use a calculator.
Do they
Luckily-
give you a calculator?
Huh?
Do they actually give you a calculator?
They have one on the computer. You go click a button, the calculator comes up, and you have to use theirs. They do not let you take anything. They even will inspect your glasses to make sure they're not those Google glasses. They are like, they check, they kind of pat you, I don't know about patting you down, they may have a wand or something, but they make you turn out your pockets. You can't wear jackets, you can't wear anything. Yes, they try to keep this real strict.
Can I wear a jacket?
Huh?
You can't wear a jacket?
I don't know, maybe.
No, it's cold.
Then you might want to wear a thicker shirt.
Yeah.
Thermals.
Good to know.
And everybody knows that where you're gonna wanna do this now. So we're getting down to probably by next week, we need to start talking to you guys about how much time do you need to take to set up to do this test. If you go through the whole thing and you don't take the test, you're not gonna take it months from now. You won't remember it. This is the best time to take it is at the end, and we're gonna shoot for somewhere around the week of the 23rd or 24th, is I'm gonna give you guys, we're gonna get through everything, I'm gonna give you 1 week for you to take the test, to study and not have to worry about starting the next part,
Of what month?
September.
September 24th.
Now, if you haven't been reading these chapters, good luck. If you don't read the chapter and do the problems, you're not gonna pass this test. My personal opinion. I know I've been doing this for a long time. And halfway, by now, actually, I don't see anybody that I know for sure is gonna pass. I hope. You might have a better chance. If he would study, because he knows a lot of this stuff already. But you gotta read the chapters. You gotta do the questions. And if you want help from me, I will be glad to give it to you. Okay, sorry we got carried away. Unrecaptured section 1250 depreciation. They're gonna probably say something to you. It's taxed at a maximum capital gain rate of 25%. Unrecaptured section 1250 depreciation. Okay, just read that stuff. 1231 property, unlike the recapture provision for 1245 and 1250, 1231 is beneficial to the taxpayer. Gains exceed losses. Each gain or loss is treated as being from the sale of a long-term capital gain. I guess you guys you can read this as opposed to me reading. Okay, I already went through this, but we're on page 266, example 9.4. This is, okay, so it's the same thing. So this year, what numbers do they use? 9.4 they use 45 and 76. So earlier they had a loss of 4,500. Is 1230, okay? Let's just say 4 years ago. So this year, they had a $7,600 gain. The first 4,500 is recaptured as ordinary income because this was taken, remember we said short-term losses are taken as ordinary income? So now, this 4,500 is recaptured as so this 76 is not going to be all capital gains. The first 4,500 is going to be ordinary. And then, what is that, 3,100? Yeah. The first 45 would be ordinary income, and the last 31 would be capital gains. Why is that a big deal? Remember, capital gains are going to get taxed at 15%. Ordinary income might be taxed at 12%, might be taxed at 22%, might be taxed at higher. I believe generally you get taxed at the lower rate if you have a choice. Gift property. Inherited property. What did we say about gift property? I think we've already gone over. Gift property, you get at the basis of the guy that gives you the gift, plus a proportion of any gift tax, but mostly it's just going to be, what does it come to you at? Of what the guy, his basis. You inherit something. You normally inherit it at the fair market value at this time. Okay, so the difference is, this happens every now and then, and I go berserk. Somebody comes in February, and they go, my mom just gave me a piece of property that's worth $100,000. She's about to pass away. And she bought it for $20,000 30 years ago. If the mom gives her that piece of property, the basis is $20,000. If she just waits and dies and that person inherits it, they inherit it at $100,000. And if it's property in Hawaii, there could be a zero behind these things. This could be 200 grand, and this could be $1 million grand. Or what? You know, and every year we get somebody go, oh, I don't actually anymore. I don't even say. I just, okay, this is what it's. If you got it as a gift, it's 20 grand. If you get it as an inheritance, it's the fair market value. Okay, you're going to get asked about that. Section 351, exchange for stock. Generally, no gain is recognized upon the exchange of property for all the stock of a newly formed corporation. So, I have land, I have machines, I have equipment, I have money, and I put all of that stuff into a corporation in exchange for the stock of that corporation, then there's no gain or loss. My basis in the stock is the basis of all the things that I gave. Has everybody got that one? That's pretty easy. Okay. Oh, we're coming to installment sales. So you have a little installment sale piece of paper. Everybody pull this one out. It says installment sale. And behind it, we have another piece of paper that on the top says, Louis sold land to Larry. Then all of this is gonna keep going flowing. So you're gonna for sure get at least one or two questions or more, so you gotta understand this. So an installment sale. What is an installment sale? It's that when you sell something to somebody and they pay you in more than 1 year. So instead of paying you, you sell them a piece of land, instead of them giving you 100 grand for it, they say, I'll give you 20 grand a year for the next 5 years. That's an installment sale. You can choose not to have it as an installment sale. You can choose to say, I'll just pay the tax this year. Okay? So how would that be?
Excuse me.
I actually did this. I sold a condominium in Texas for like $35,000. That would be worth a zero behind it here in Hawaii. And the guy paid me so much. But instead of me doing the installment sale, I realized that there wasn't that much. I didn't care about it, so I just took, let's say that you're not gonna believe it, I bought a 2-bedroom, 1,000 square foot condo in the rich part of town for $10,000. That was 30 years ago. When I moved to Hawaii, and I remodeled it, and I moved to Hawaii, I had no use for it, so I just started renting it out. And after a while, I had the tenant from hell that stole everything in my condo. So I I'm selling. So I sold it. And the guy wanted to do it in installments. So instead of taking the profit, I just went ahead and took the whole thing, because I didn't wanna have to deal with doing installment sale for 30 years. As it turned out, I didn't. But what I did do is I got, to you guys, I don't know if you're familiar, I got 9% interest. 9% interest is a really good deal.
Yes.
Because he was a young college student and he was backed by his dad, and took him a while. Finally, after about 10 years, they realized that was a bad deal and they finally bought me out. But I had 9% interest for 10 years. That was really a good deal. Okay.
Yeah.
Anyway, so how does that? I forgot what we were talking about now. Okay, you don't have to take the installment sale. You can just okay. So 35,000. We'll say 10,000, and we'll say $5,000 worth of expenses. So I had a $20,000 gain. I just took the $20,000 gain in that year, no problem. Okay. There was, in reality, there would have been depreciation in there too. Does everybody understand? The next thing, if you have depreciation, so we'll say we have a $100,000 rental condo, and they had $30,000 worth of depreciation, and you want an installment sale, and they want to give you $20,000 a year for 5 years. 20, 20, 20, 20. Okay? You bought the place, we'll just say you bought it for $50,000. You got $30,000 worth of depreciation. Your basis is $20,000. So you're going to have, let's go. 20,000. You have 80,000 of gross profit. Okay, and you would have a gross profit percentage of 80%. So 80% of all each time you got 20,000 would be capital gains. So 80% would be what, 16,000? Every year you'd have 16,000. Everybody, that's the simplest one. So here are the questions. They're going to ask, at least give you this kind of information, and they're going to say, what is the gross profit percentage? Your gross profit percentage. In that case, it would be, you had profits of 80,000, and the cost was 100,000, so 80 over 100 is 80%. So let's go look at this installment sale. Okay, so first you start with the selling price. Everything realized. Remember the word realized again. Okay, the contract price, selling price less mortgage loan relief. And the problem that I gave you up there was no mortgage. But if you did, that changes. Adjusted basis is what? The cost of whatever your property is minus any depreciation plus what? Any improvements? And you'd add selling cost if you had any, and this is the tricky one. Okay. So now I'm gonna sit here and go through. So adjusted basis is cost minus depreciation plus selling expenses plus recaptured depreciation. Remember how we had, in this case, we had 30 grand worth of depreciation? So we had $100,000 minus the 20,000 basis, 50,000 cost minus the depreciation is only 20,000. So we have 30,000 worth of recaptured depreciation in ordinary income. Okay, so this is your 80 over 100,000 is 80%. But we had $30,000 worth of depreciation. So how does it go for your adjusted basis? In this case, your adjusted basis is this 50 minus 30, add back the 30 plus any selling expenses. So really your this becomes 50,000 again. And so now your gross profit percentage is 100 over 50 or 50%. Why is it doing that? There's a rule that says if you have any depreciation you have to recapture on an installment sale, you have to recapture it the first year. So on top of having to pay taxes on the portion of that 20,000 that we had. Remember I was saying they gave you 20,000 the first year, and so at 50%, so 10,000 would be taxable the first year, but you also have to put on a 4797. You'd have to put this $30,000 of recaptured depreciation, and it's recaptured at ordinary income. This 10,000 is recaptured at capital gains rates. It's a capital gain. So the first year, they would pay tax on 40,000. After that, they would have, let's see, there's one, there's another 20, there's a fourth one. So 10, 1, 2, 3, 4, there's 40,000. And 30 would be the 80. So even though it's $80,000 gain, you're paying tax on this $30,000 the first year, and $10,000 over here the first year. You're looking like it. Does it make sense? Okay. Let's go through with the problem in the book. It's the most, if you get this one, you need to be able to get this one, because this, they're gonna have one like it. So, the selling price is everything you get. The contract price, selling price less the mortgage relief. I haven't been giving you any mortgage so far. But what that means is that that's the number that you're gonna use to divide in to get the gross profit percentage. Adjusted basis, cost less any depreciation, plus selling cost and recapture depreciation. So you subtract the depreciation, then you recapture it. This only applies to installment sales. Okay, so then you have a gross profit. Selling price less the adjusted depreciation. Okay? Then gross profit percentage is the gross profit divided by the contract price. Okay, and contract price, remember up here, selling price minus the mortgage. After gross profit percentage times the money received is the taxable income. Those you're gonna have to, you gotta have this down. So let's go through a problem right here. You got 20 minutes. I'll get you through. This is the most important part. Okay, so Joe's Construction sold a machine with a cost value of $1 million and with 150 of depreciation. He sold it for $2.4 million to Bubbles Construction Also assume Joe's loan of $500,000. Whoa. Joe's selling expenses were 10 grand. Bubba paid 40,000 plus interest each year for 6 years. 400,000 times 6 years is 240,000. Just for your benefit. So what's the selling price? He gave him $2,400,000 and took over a $500,000 loan. Does everybody understand that? Okay. The contract price is that selling price minus the loan. Because he's only given him 2.9 million, he took over a loan. So that doesn't apply to this. The basis, 100,000 minus the 150,000 depreciation plus the 10,000 of selling expenses minus the recaptured depreciation. So the basis is a 1,010,000. Everybody staying with me so far? The gross profit is, you subtract the 2.9 million minus the basis, and you get 1,890. Okay, that's the gross profit. That's how much money you made on selling. Who's calling me an Aiden?
Good answer.
Hello. Okay. Fine. Lisa from the Big Island, she's lost where we are. Okay, Lisa, we're not on a page, we're on installment sales. Yeah, she has it, but she probably just didn't. Lisa, I hope you got it. But it's also page 268, 269 in the book. But we're doing, this problem is from the handout. Okay, so guys, so we get to the gross profit is the amount, the sales price, 2.9 million minus 1.010 million gives you a gross profit of 1,890,000. Okay, and if you take the contract price divided into the gross profit, you get a gross profit percentage of 78%, 78.75%. Everybody see how that goes? Okay, so the first year and every other year, he's gonna get 400,000. 400,000 times the gross profit percentage means he has taxable income of 315,000. The first year, he has recapture of 150,000 that goes on the 4797 and capital gains of 315,000. If you can do this, you can do any problem that they throw at you. Here's how they're going to do it. One problem's going to ask you, what's the gross profit percentage? Another problem is going to give you the same information. They're going to say, what is your taxable income? Another one is going to go, what is the contract price? Okay? And all the different problems are going to revolve around doing it just like this. If you get this whole thing, fine. If you don't, call me and let me help you. Now, that's the one that's a bigger one. The next two problems with Larry and Tony, we're going to go over. That's the last we're going to go over tonight. We've got this other two that I gave you are going to be for next week. The ones with Mr. Obama and Mr. Trump buying and selling land. Who knew that they were going to be such good friends?
Oh, I don't think,
I
I don't have Mr. Trump's.
You don't have one that says.
Oh, wait, I'm sorry. It's in mine.
Okay.
Let's get back, thank you.
All right, so yours doesn't have all the writing on it. I had planned to do this in front of you to show you. In fact, that's what we're gonna do. Okay, both of these are sort of, so, the first one is Louis sells Larry some, we'll say, land, and then, in the middle of the deal, Larry goes belly up, and Louis has to take back the land. So we wanna know, what's Louis' new basis in the land, and what's the taxable gain? Okay, it's in your book. If you will go to page 270 at the bottom, it says example for the calculation. The numbers in the book are different than the numbers I've got on my problem. You can, but they're gonna do whatever you wanna do. So, I just made out a whole brand new problem. So, we're gonna go, he sold the land to Larry for 100 grand with adjusted basis of 40 grand. That means he must have had $60,000 worth of depreciation. Larry said that I will pay you $20,000 each year for 5 years. And after 2 payments of $20,000 each, Larry defaults and Louis repossesses the land. Oh, this was land, there is no depreciation. Okay, so what we're gonna do is find Louis' basis. So let's start off with we're gonna find out what's the taxable income. And if that's on the bottom half of this. So you're gonna go total payments received. So what did he receive? 2 payments of 20 grand. So he received 40 grand. Okay? And out of those 40 grand, how much of that has been reported as income? So let's see. 40 grand, and what is the gross profit percentage? We need to know that before we go any farther, huh? So 100,000 minus 40,000 basis leaves 60,000. Okay, contract price and sales price are the same because there is no loan, there is no mortgage. So if you take 100 grand over 60 grand, you get 60%. Everybody good? One of the questions you're going to be asked is, what is the gross profit percentage? The gross profit percentage in this is 60%. So of that 40,000, how much of it was taxable for the first 2 years? And it should be 24,000. Because that is 60%. So 20,000 times 60% is 12,000 for each year. 24,000 is the taxable amount. So good, so all right. So what is the gain? Gain on the repossession, 16,000. What was the gross profit on the sale? 60,000. And I didn't put him in the problem, but he's got a 3,000. I put the repossession cost of 3,000. Okay. So if you look at the book and you add lines 2 and 5, line 2 is 24,000, and line 5 is the repo cost of 3,000, so that would be 27,000. And the difference between 60,000 and 27,000 is 33,000. And then the bottom line is you take the lesser of line 3 or 7. Line 3 is 16,000, and line 7 is 33,000. So should be 16,000. Does everybody see how that works? If you do the problems in the back of the book or anywhere, take this and do them with this until you can get it, till you can figure it and do it a couple of times. They may not give you this hard problem. This is a really hard one. I couldn't have done this without looking at the book. I took this book, made a copy of this one page, then did the problem. It was way easier that way.
How did you get 24,000?
24,000? Okay, each payment, or 40,000 times 60%, your gross profit percentage. 20,000 is each payment, right? They had 2 payments, so 40,000.
Yes.
60% of 40,000 is 24,000. Okay, and that's the part you've already paid tax on. Out of this 40,000, they pay tax, 12,000 a year on the first 2 years of 24,000. So they only have left over 16,000. So then line 7 at the very end, it says which is the smaller, and the 16,000 is smaller. So you take that, and that is what you're gonna, so we go up to the top part and we go, what's the unpaid balance? Out of the 100,000, they've already paid 40,000, so the unpaid balance would be 60,000. Okay? So now we've calculated that 16,000 is the amount of gain for this year. After this year, he has it back, and he's gonna have a basis in it, and then he gets to sell it again. Maybe. Okay, so 60,000, we already took 40,000 out of the 100, so now we have 60,000 less. And from that, we take 60% of that. This is the unrealized profit. This 60%, or 36,000, that's what they didn't get. They didn't get their other 36,000. Okay, so you subtract the 36, the basis, the unrealized profit from here, you get what? 24,000. Okay, you add to that the 16,000, the 3,000, and you get 43,000. That's the basis of the property that it got back. I suggest you just, you use they've already got a problem in here for you, but I didn't want to put that because I wanted to let you have a separate one to do. Now, if anybody wants, I've already got this already made out on a sheet of paper. I wanted to give you a blank one, but I'll be glad to make you guys copies of this.
Yes, please.
Okay. 6. While it's making copies, I'm not going to stick around here. I'm going to finish up. We are about done for tonight.
So what's the answer? What's Louis' new basis?
43,000.
43,000.
And the amount of capital gain? 16. Oh, wait. just pass those around. Yeah. Okay, on the bottom one, Tony sold land to Bob for $100,000, had adjusted basis of 40, with a down payment of 20 and 8,000. Okay. There, it's on page 271 of the book. There's a problem like it, but this one's right here. Lisa, if I can remember, I will make a copy of this and give it to you tomorrow. She hasn't got a speaker, so she can't talk back. I actually like it, Lisa, that you can't talk back. This is a good thing. Okay, so $100,000 minus $40,000, he has a gross profit of $60,000. So his gross profit percentage is 60%. They had a down payment of $20,000 from here, and he's paying $8,000 a year for the next, is that 5 or 6 years? 5 years? 5 years. Okay, he paid 2 payments of $8,000 each, so he's paid $36,000. He still owes $24,000. Everybody got that?
Mhm.
So the $24,000 that he owes, not all of it they're not going to get the 60%. So you take the $24,000 and the part that he doesn't get, the part that's capital gains, 40% times 24,000 is 9,600. That's his basis. He's going to be given 15,000 minus his basis. He has a gain of 5,400. You've got this. Now you've got 2 problems. Hopefully that at the end of it you'll get it. If not, call. I'll be glad to give you some time. All right, so I don't think there's anything left. This is one of the harder chapters. So, but if you guys got this, it's a piece of cake. If not, call and let me help you. But also, read the book first. Not read the chapter, then come in. All right, you guys ready to go, or do you want to stay around and party down? Just kidding. Okay, so let's just say we've done the first 9 chapters. Okay? We've got 2 more weeks. Okay? Then, let me just make sure how this is gonna go. I think we're,
And 4 chapters. Oh, 5 chapters. 9, 4 chapters. Deductions and credits.
okay, this is the most important one. This is up to you guys. How do you want to do this? We're 2 more weeks, we will have finished the chapters. Then we can have a week to go over everything again that you don't know. Okay? Or we can crush right on through it if you think you've got it and you're ready to take the test in 2 weeks. If not, we'll have a week to do that, and then I'm going to give you a week off on the 23rd, 24th, and 25th of September to take the test. Does anybody here feel that they've got this good enough that they can just take the test without anything? No. Okay, had you rather go ahead and make sure you have this first one before we crank into the other? Okay, so we're going to take these next 2 weeks, we'll do the last 4 chapters. The following week, we're going to review everything, and everybody that doesn't think you got it, call me and let me help you. The week after that, you should probably have scheduled your test in September 22nd, 23rd, 24th, 25th, 26th. or before that if you think you got it. But you need to start getting ready at some point real soon, because if you go try to schedule it the last minute, they may go, oh, we don't have any tests available. Because not only are they doing tests for this, they're doing all the tests. All the doctors, engineers, nurses, everything goes through Prometric.
Thank you very much.
Okey-doke.
See you again.
Got it. Okay, this week and next week are gonna be the ones with a lot of the problems. Next week is gonna be just like this one, but